You're paying way too much in taxes. So here are 10 year-end tax moves that you can make to save yourself up to tens of thousands of dollars in taxes right now. My name is Jacob Wade. I'm a former enrolled agent and I'm a financial coach that wants to help you take control of your money, and taxes is one of the best ways to do it. So first things first is to max out your 401k contributions. Now, listen, I know there's not much time left in the year, but you could put up to $23,500 into a 401k or up to $31,000 if you're age 50 or older. That's a huge amount. And every dollar you put in there on the traditional 401k is deducted from your income. So massive tax savings, especially if you're in a higher tax bracket. Now, the only way to do this is from your paycheck. So you would have to go to HR and say, hey, can I dump a huge portion of my paycheck into this if you haven't gotten close to maxing it out already? Maybe you've already put some money in. Maybe you've gotten that company match, but maybe you have an extra $10,000 you can throw in there. Just say, hey, HR, put my last 2 paychecks completely in the 401k. Right? Max that out if you can. Now, the potential tax savings is huge. So if you max this out, $23,500, and let's say you're in the 24% tax bracket, that's over $5,000 in tax savings. It's literally going to lower your tax bill by over $5,000. And if you're 50 or older, just that extra $7,500 you put in there is another almost $2,000. So there's over almost $7,000 in tax savings in this one account alone. So if you haven't maxed it out, put as much as you can in the next couple of paychecks. All right. Number 2 is making IRA contributions. Now, an IRA is an individual retirement account outside of your workplace. So you go to somewhere like Vanguard, Fidelity, or Schwab and open an IRA. Now, you can get a deduction this year, but there are quite a few limitations on getting that deduction. One, you have to have a little bit of a lower income. So as a single filer, $79,000 or less, or married filing jointly, you got to have $126,000 or less. And you can't have a 401k. That complicates things. So if you have a workplace retirement account, it might not be deductible. So if you don't meet those limitations, maybe you don't get the deduction this year, but you can still put money into a Roth IRA. Now, what's really cool is whether it's traditional or Roth, you could put up to $7,000 a year in this for you and your spouse if married, or an extra $1,000, right? Or $8,000 total if you're age 50 or older. What's really cool is, so my wife doesn't work, for example. She's at home. She doesn't earn an income, but I can still open a spousal IRA for her and contribute to it. So I could put $7,000 into mine and $7,000 into hers. That's $14,000. Now, if we get under these income thresholds, that would be a $14,000 deduction. But if we can't, we could still put money into a Roth IRA. Now, the income limits are a little higher, right? If you're single, you can contribute, earn up to $150,000 a year. If you're married, up to $236,000 a year before they start to reduce what you can put into a Roth IRA. But putting money into a Roth IRA grows tax-free, no deduction now. It grows tax-free. And when you get to retirement, all that growth, you can start pulling money out for retirement tax-free. That can be a massive savings in the future, literally tens of thousands of dollars. Now, you might say, okay, well, I still make more than the Roth IRA income limits. Don't worry. There's another option there called the backdoor Roth IRA. Now, I won't get all the way into it in this video, but the idea is you contribute to a regular IRA. You open both a traditional IRA and a Roth IRA. You can go ahead and do that. It's free. You can do it at Fidelity, Schwab, Vanguard. Doesn't matter. Open both accounts, traditional IRA, Roth IRA. Put money into the traditional IRA, but you're not going to deduct it. And then you're just going to roll it into the Roth IRA. You do a conversion. Then all you have to do is file Form 8606, with your tax professional or online, and just say, oh, this is a rollover from the traditional to the Roth. It's just the backdoor Roth IRA. It's something I do with my clients all the time because they are high income earners, but they are able to contribute, again, $7,000 into each Roth IRA with no problems using this opportunity. Now, the potential tax savings for a traditional IRA, let's say you do stay under these income limits here, you can save, $1,500 in taxes if you're in the 24% tax bracket, or you could save, maybe an extra couple $100 if you're age 50 or older and you put that $8,000 in. So almost $2,000 in potential tax savings. But I think the real win here is the Roth IRA and the future potential tax savings of tens of thousands of dollars, potentially every single year, depending how long you let that thing grow. All right. Number 3. Consider doing a Roth conversion, right? We talked about Roth IRAs and the advantages of those and how they grow tax-free and you pull them out tax-free at retirement. Well, getting money out of a traditional IRA where you already got the deduction into a Roth IRA can be massively advantageous in the future because, again, all that tax-free growth and tax-free withdrawals at retirement. You would do what's called a Roth conversion. But here's the key. You don't want to convert traditional assets to Roth assets in a high income year because it's counted as income. So if you convert $20,000 from your traditional IRA to a Roth IRA, that's an extra $20,000 of income. And if you're in the 32% tax bracket, right, you're paying an extra like $6,000 in tax. It's just not worth it. But if you take a year off, which some of my clients do, we hit a milestone called Coast Fire and help them take a sabbatical, for example. Or for me, I took 2.5 years off of work and I had no income for a couple of years. In those low income years, now you're in a very low tax bracket. And if you convert $20,000, you might pay almost nothing depending on your deductions and your exclusions and the standard deduction. So you could convert a ton of money from Roth to traditional in those low income years, or if your business is down, whatever. And now you're basically protecting your future from future taxes. You already got a deduction on the traditional side. Now you roll it into the Roth and you're going to not pay taxes in the future. It can be a massive opportunity for tax savings. Again, assuming you just do this rollover now, you do have to pay taxes. Like, let's say you do it when you're in the 12% tax bracket instead of the 32 where you're normally at. You have a down year, take a year off, take 6 months off, whatever. Well, you convert 10,000, it's about $1,200 in taxes owed. And maybe you convert 20,000, it would be double that, right? About $2,400. But considering the tax savings on that growth, right? That maybe that 20,000 turns into 200,000 in the next 20 years. By the time you want to retire, you start pulling that $200,000 out and you're paying zero taxes. Massive tax advantage. It's something, and it's a little more of an advanced strategy, but something my clients do all the time to save a ton of money in the future. And here's a quick example of that. So let's say you pull it out and you pay that 12% in taxes, but in the future, you're anywhere from 22 to 32+% tax bracket when you're trying to pull the money out in retirement. Well, you pay $2,400 now, but you would probably pay closer to $5,000 later. So just that one conversion alone is going to save you $2,400, but not to mention the tax-free growth. And if your money 10Xs, zero taxes, right? So it's more like a tens of thousands of dollars tax savings. All right. The next one is what's called harvesting tax losses or tax loss harvesting. You can do tax gain harvesting as well. We won't really get into that, but tax loss harvesting, a little bit of an advanced tax strategy, but it's for those that have a regular brokerage account, right? Maybe you've maxed out your 401k, your IRAs, your HSAs, all your tax advantage accounts are taken care of, but you also have money that you're investing in a regular brokerage. Maybe you got that Robinhood account, maybe just a Vanguard or Fidelity account, and you're putting money into it, but you don't want to pay, extra taxes when you have gains in that account, or maybe you just want to offset your income taxes now. So what you can do, let's say you've been investing, is you could find the losers, right? The investments that haven't panned out this year that actually have a loss from when you purchased it. So maybe you purchased it at $10,000 worth of stock and it's only worth $8,000 now. Well, you sell that stock and you capture that loss. That is a $2,000 loss that you can now write off against your ordinary income taxes. Now, what's really cool about this strategy is you could do it with multiple investments, just sell the losers, capture those losses, and it can offset up to $3,000 in ordinary income tax for the year. Again, $3,000 deduction if you're in the 32% tax bracket could save you $1,000 in taxes just like that. And all you're doing is selling off these losers. Maybe you hang on to the winners. Maybe you take that money and just reinvest it in something else so you can put it right back into the market, assuming it's not the exact, you can't rebuy the same stock within 30 days. It's called a wash sale. But other than that, you just get your money out of that one, put it in this one, you capture that loss, and now you can deduct it. What's really cool, even better, is if, say you had a substantial loss. Maybe you had $20,000 in losses and you sell those stocks. You can deduct $3,000 now, but that extra $17,000 rolls over to next year. And then you can take that and deduct the $3,000 again. And then the leftover $14,000, you could deduct $3,000, right? You could just keep rolling this forward and deducting $3,000 a year against your income taxes. Again, an easy $1,000 tax savings every single year if you're in a high income tax bracket. Again, here's just a quick example. $3,000 of ordinary income at a 24% tax rate saves you $720, plus unlimited offset of capital gains. So say you did have something that did really well. You bought NVIDIA, you sold it, and you made $10,000. Well, you could offset that $10,000 with $10,000 of losses if you sell another stock. Again, a little bit more of an advanced tax strategy, but something that can help high income earners or people that have massive gains in their regular brokerage accounts save a ton in taxes. All right, the next one, prepaying eligible expenses. Now, this one's interesting. So if you are close to itemizing your deductions, standard deduction, right? It's like very high, almost $30,000 for married filing jointly, or maybe it's even higher at this point. But if you are close to itemizing your deductions because you have high mortgage interest, you donate a lot, you have high property taxes, or you have other expenses that are eligible for itemized deductions. And say you're close to that limit, or maybe you've hit itemization and you want to maximize it, you could prepay things like mortgage interest, right? Maybe you make a mortgage payment ahead of time this year and capture that mortgage interest. Maybe you prepay your property taxes. Instead of February, you do it in December. Maybe you make extra charitable contributions, something that's going to increase your itemized deductions for 2025 and not wait until next year. Now, this is important to consider the SALT deduction limit. Now, I will say Trump just raised it to 40,000. It used to be at 10. So, it's a lot more generous than it used to be, but make sure you understand the state and local the SALT deduction limits when you're trying to maximize this. But if you can prepay eligible expenses that are eligible for itemized deductions, you can lower your tax bill. And again, for those in a higher tax bracket, this can be huge, right? So prepaying $1,000 in deductible expenses will save you $240 if you're in the 24% tax bracket. But if you prepay $5,000 or maybe an extra $5,000 donation right now, you could save over $1,000. So real tax savings can happen with this strategy. All right, next, making charitable donations. Now, we just talked about this, but there's another strategy I want to talk about here, which is donating appreciated stock. So let's say, again, you have that account where you're doing some tax loss harvesting, but you also have all this appreciated stock and you want to donate some of it because it'll be part of your donations for the year. What's really cool is if let's say you bought NVIDIA and it doubled in price, you put 10 grand in and now it's worth 20. Well, you want to donate that whole 20 grand to a charitable, eligible charitable charity. You can put that stock in there, donate it to them, and you won't have to pay that capital gains tax on that 10 grand of gains. It just goes right to them. But you also get the fair market value deduction of its current value. So you get a $20,000 deduction and you avoid paying capital gains tax on that 10 grand of gain. So it's like a win-win. So donating appreciated stock can be really helpful. Again, helpful to the actual organization you care about and you want to donate to, but also saving you on taxes at the same time. Now, if you have a large amount of appreciated stock or that you want to donate, you might want to consider what's called a donor advised fund. Again, this is a more advanced strategy, but what this allows you to do is donate a ton of appreciated stock into the fund. It's now outside of you. It's no longer owned by you, and it must be donated to charitable organizations, but you could take the full deduction this year. So say you have 100 grand worth of stock. You put it in there. You don't have to pay any capital gains on it. And now you could take a $100,000 deduction this year. But then you can distribute from that fund over time. It doesn't have to be all sent to a charitable organization right away. So kind of a cool strategy for getting the deduction now and then giving over time. So here's a quick example of potential tax savings for this strategy. Again, a cash donation of $1,000, just an extra cash donation would get you $240 in savings. But if you do the appreciated stock donation, right, say you donate $5,000 of appreciated stock, $1,200 federal tax deduction at a 24% tax bracket, but you don't pay capital gains. So say you had, bought it at $3,000, but now it's worth $5,000. That's $2,000 in gains, which would be about $300 in capital gains taxes. Now you just saved another $300. So $1,200 federal tax deduction savings plus $300 in capital gains tax saved. So again, a little bit more of an advanced tax strategy, but it can be done fairly quickly. You can get it donated by the end of the year, and then you can take the deduction now. All right. If you have an FSA, I feel bad for you because I hate these accounts, but there are some specific circumstances where they make sense if you're just going to put money in and take it right back out for an eligible medical expense. But a flexible spending account, FSA account, is use it or lose it. So if you've got money in there, you got to get it out before the end of the year. Otherwise, you're not going to have that money. Now you get the deduction, right? So the money you put in is deductible, right? And it usually comes from your paycheck, but you got to use it for eligible expenses. Otherwise, you lose that money. So things like maybe buying glasses or getting some dental work done or prescriptions, over-the-counter medications, whatever your medical expenses are, just make sure you use those funds right away. Now, one cool thing is the FSA is not only deductible on the federal level, but a lot of times Social Security and Medicare and even state level deduction can be had as well. So it could be a pretty good tax savings, but you need to make sure if you put the money in there to get that tax savings that you get it out of there and actually get it used. Now, not all FSAs are that stringent. Check if your employer allows rollover of funds to the next year or maybe like a grace period. So maybe December 31st isn't the deadline, but usually they are. So get that money out of there. All right. Number 8, review your withholding and estimated tax payments. Now, this is important. A lot of people don't know this. If you underpay your taxes by $1,000 or more, you could get hit with a penalty, which isn't fun. Nobody wants to pay even more taxes than the taxes they're already paying. And for a regular W-2 worker, you got a regular job. This doesn't usually happen, but I have seen it happen for a dual income, high income household. So if you both make 200 grand, even if you claim zero exclusions and withhold the maximum amount of taxes, and so your spouse's job makes a ton, you make a ton, and your withholding is only based on your own. And so you could still underpay your taxes and get penalized for it. I've had people that had to do this. So use a tax withholding calculator or maybe meet up with your CPA real quick and go, do I have enough paid or should I do a one-time payment or estimated payment to the IRS to make sure I'm not underpaying my taxes? You have till January 15th to get that estimated payment in for Q4, for the end of the year quarter. But it's important to just understand this. And again, as a small business owner, you should be making these estimated tax payments as well. But for workers that have high incomes, they might not realize this. So save yourself the headache and the extra taxes owed and just calculate, am I withholding enough, especially between a dual income household? I've got 2 for small business owners here. Number 1 is if you need to buy needed equipment or software or something for your business, there's something called the Section 179 deduction and bonus depreciation that allows you to take full deductions on larger purchases. So Section 179 is things like phones, computers, office upgrades, software, things where you have to make necessary purchases for a business and you can deduct the entire thing right away. Now, what bonus depreciation is typically you buy a larger item, even up to a vehicle sometimes, and usually you would depreciate that thing over time, right? Over 7 years or whatever. If it's equipment, it could be a lot longer, but the bonus depreciation allows you to take a much larger deduction on that thing, so that you can save a ton more in taxes right now, offset your income. So if you've had a very profitable year, you're going to want to consider making pre-purchases by the end of the year so you can take things like bonus depreciation, Section 179, expense deductions, and just lower your tax burden as much as possible as a small business. So consider this. Again, only purchase what you need. It should go without saying. Deductions aren't worth the purchase. Don't go get a G-Wagon because you can get a deduction. It's a waste of money. The thing will depreciate like a rock and it's going to be worthless. Don't go do that. But if you have legitimate expenses that are coming up in the next couple of months, might as well prepay them now. Now, some potential tax savings. Again, this is assuming around a 24% tax bracket or effective tax rate. Deducting up to $10,000 can save you up to $2,400, right? This is just dollar for dollar. And again, as a small business owner, you're usually paying your half of self-employment taxes as well as the employee half, which could be you, right? So you're paying an extra 7% on that. So the savings is potentially even higher than shown here. But again, if you pre-purchase those things that are necessary for the business, you could save thousands of dollars in taxes right now. All right, and finally, for small business owners, set up and contribute to a solo 401k or a SEP IRA. Now, I will tell you, I'm a bigger fan of the solo 401k. I think there's a lot more flexibility, especially for single business owners. Obviously, if you have employees, you can't do the solo 401k. But as a small business owner myself, that is a single business owner, the solo 401k allows me to deduct up to $70,000 while still controlling my taxable income from my corporation. So I'm not going to get into all the details here. This is something I walk my clients through because this is a huge win, not only on the tax savings side, but the ability to maximize tax protected contributions to retirement and help people retire decades earlier. Like, this is the key. The solo 401k is a magical account. But the SEP IRA is fine too and allows you to put in money that can be deducted. But the idea is you must open the solo 401k before December 31st. if you want to contribute to it. Now, you can contribute up until your tax day. So if you're a corporation, that would be March 15th. If you are a just sole proprietor, that's April 15th. Or you can even wait until your extension date. So again, as a corporation, that would be around September 15th, or a sole proprietor, that would be about October 15th. So you have to establish it now, the solo 401k. You got to get that thing open, and I'll have a link below to a recommended provider that I like. But once that's open, you can contribute up until tax day. So you got to get that open. Now the SEP IRA is a little more flexible. You can open the account after this. So it doesn't need to be open right now, but you have to open and fund the account by tax day or by your extension date. Now, the cool thing is on the solo 401k, you can put up to $23,500 in as the employee of the business. But the business itself can also contribute up to 25% of the compensation of that employee, or up to 20% if you're a sole proprietor. Now, the SEP IRA is a little bit different, where you can only contribute up to 25% of the compensation. There's no like employee piece of it. It's just the business is going to be contributing to the SEP IRA. So that's why it's a bit more limited. You would have to raise your compensation to be able to put more money into it, which means you're paying higher income taxes. So again, I love the solo 401k. SEP IRA is fine. And I think you can get a free one or a low cost one from Fidelity, but I really like, it's called Carry Money, the solo 401k. Again, I'll put the link below, but if you're a small business owner and you're not putting money into a solo 401k, you're missing out on massive tax advantages. Now, some potential tax savings. Again, if you're contributing, say 20 grand as an employer, whether it's the SEP or the solo 401k, it could save you, $5 grand in taxes or more, depending on your tax bracket. And if you fully max this thing out and you put in money on the employee side, like the solo 401k, and the employer side, you could save up to 17 grand-ish, which is huge. But again, the big win is actually putting in tens of thousands of dollars to this tax advantaged account that will grow tax-free and get you to retirement so much faster. All right. I told you I'll give you 10 year-end tax tips. Now you got to do something about it. Actually implement these things. You could save tens of thousands of dollars potentially implementing just a couple of these strategies. If you need help with this, I do tax strategy. I do personal finance coaching. You can hit me up. I'll put a link below to a free consultation call. We could chat about it. Maybe it's a good opportunity to save yourself some taxes, get investing better, and start growing your wealth faster. So if you want to apply for money coaching, just hit the link below, roadmapmoney.com/apply, and we could chat. See if it's a good fit. See if I can help you save tens of thousands of dollars and help grow your wealth. If not, no big deal. We could just chat about it, but just hit the application below and we'll talk soon. And don't worry. Yes, you can have a copy of this Google Doc. I've got a link below. Just open it up. It'll say, do you want to make a copy? Hit, yep, I want to make a copy, and it's yours for free. I want you to have this. I want you to start implementing these strategies. Now, saving on taxes is great, but what's the end goal? How much do you actually need to retire? That's a question I answer in full, in detail, with tools right here in this video. So check it out.